Good morning, everyone. Well, I am impressed. 8 o'clock on Saturday morning. This is impressive. Welcome.
Really? It's horrible.
Y'all ready to take a little trip with me and find out what's in store for the economy? This last trip I made with Tom Gresham, we didn't come fully equipped, so I'd recommend helmets and life vest and so forth. We actually survived this pretty well. Tom lost his glasses. He didn't have a protective case and injured his head just a little bit. Ended up taking on the presidency of Sigma just as they were in need of finding a new executive director. But he's fully recovered now, and he's finished that tour of duty. So, as we look at the economy, certainly something that we're all aware of in this room and that's had a dramatic impact, with some people being big winners and some people being big losers, has been the very dramatic decline in the price of oil from over $100 a barrel in early 2014, to the low 40s currently. And as we think about who's benefited from that. Certainly, consumers, that's just money in their pockets that they didn't have before because they have to consume a certain amount of fuel, whether prices are high or low. And as they've had that additional money, of course, it's created more disposable income, some of which hopefully you've been able to capture in your stores. I had dinner with the people at our table last night was Bonnie Herzog, who's a tobacco analyst, and she said that tobacco sales are up in part from this additional income that consumers have. And of course, you people as retailers have enjoyed one of those remarkable times when, as prices fall, margins get bigger, and so one of the better 12-month periods of time for convenience store retailers. Certainly, big fuel consumers like agriculture have benefited tremendously, but unfortunately, we're not only seeing a decline in oil prices, but we're seeing a general decline in commodity prices, which is taking its toll on the agricultural sector as well. Auto manufacturers are enjoying some of their best periods of time in many, many years. And the mix of vehicles being sold has changed. Presently, we're selling about 55% trucks and SUVs, which is up from about 45% in the summer of 2008, when oil prices were over $140 a barrel. And certainly, the transportation, airline, hospitality industry, huge windfall gains for them, as they're a major expense for them. Fuel have dropped dramatically. At the same time, we have some significant losers. If we look at the global oil industry, many projects have been canceled. As of recently, about $200 billion of major capital projects have been canceled from low oil prices. The active rig count is down 63% year over year. Employment and production in the industry is falling, and hit a 12-month low for the month of October. This obviously impacts the mid-continent regions of the country the most. Alaska relies on oil revenue for 78% of its revenue. North Dakota 46%. Texas, a very big state, up only 9%. Oklahoma 6%. Manufacturing, another area that was enjoying a huge boom related to the energy boom in the United States, as there was a mini resurgence in the steel industry with pipe and so forth, and with that a decline in drilling activity and so forth. That's taking its toll on manufacturing, and manufacturing that's also export dependent is also suffering. So if we look at some of the many indicators of where are we headed as a country as it relates to manufacturing, most of these indicators point to contraction in manufacturing. If you look at the right scale there, any reading below 50 is interpreted as being contractionary and so forth. So this is not necessarily a great sign for the U.S. economy. One of the things, if we look just briefly at the global picture, is that we keep lowering the forecast of how the global economy is going to be doing. And I put the forecast for 2015 for April, July, and October. The latest forecast is down to 3% that just came out. And then in 2016, the latest forecast is for 3.3. And these global economies, include emerging economies like China and India. China has had an 8% drop in its exports year over year. The cost of shipping a container from Shanghai to Europe has dropped in half over the last 6 months, just because of the decline in the volume of trade and shipping companies, wanting to be competitive and fill their containers. So many of these emerging economies, of course, have relied on China as a source of exporting commodities, raw materials, and so forth that are used in manufacturing. And they're suffering dramatically as a result of the slowdown in the Chinese economy. We'll probably see some third world debt default coming up here in the next year or so. If we look at Europe and compare it to the United States, you can see we both went into what's now been called the Great Recession, where there was a dramatic decline in output in 2009. We both enjoyed a similar bounce back in terms of economic growth. The European Central Bank actually started to raise interest rates. Very miscalculation from my viewpoint. Europe went back into a recession, and it's since come up. But you can see that even though we think the growth in the United States has been slow but steady, European growth has been teetering on recession here. And of course, they're a major trading partner for us as well. So I think the latest statistics for Great Britain, their GDP growth was like 0.5%. I think for Belgium it was 0.2%. And those are traditionally healthier economies on average in the European Union. So as we've seen this weakness in the global economy, it's pushed the value of the dollar sharply higher. As we go back to 2010-11, the trade-weighted index of the U.S. dollar was around 100 or even a little bit less. It's now 120, which you can just interpret that as meaning everything that we're selling costs the rest of the world 20% more than it did several years ago. That makes it very hard for our U.S. manufacturers that are competing in global markets to be competitive, because it's just like their costs have gone up. It makes it hard for our agricultural sector to export and so forth. It also makes it hard for multinational corporations that have significant operations overseas and have to convert their earnings in foreign currencies back into dollars, because a given dollar earning in a foreign currency translates into less dollars. So the year-over-year sales for the S&P 500 down 4% and earnings per share down 2%. So it's no wonder that the stock market is, I would say, hesitating at the present time. If we look at new orders for export goods, on the right scale there, again, when it's below that line, it's kind of in a serious territory. So you can see the general downtrend there. So I hate to start the Saturday, a new conference. We all want to be excited and upbeat, but I need to be realistic. Not all is great in the United States. So what really is the economic outlook like? Where are we headed? Well, our current expansion, believe it or not, is over 6 years old, 76 months old. The average of all of our expansions is about 5 years, so we're greater than average. Doesn't necessarily mean that we're due for a recession, because you can see by the various periods of economic recovery that they're highly variable and so forth. But the R word is starting to appear in people's vocabulary. Let me just say that, okay? If we look at GDP growth in the third quarter, it was 1.5%, down from 3.9% in the second quarter. That looks perhaps worse than it actually was. When we measure GDP, we're looking at the value of what's produced. Sometimes firms get ahead of themselves in production, and so inventories get built up, in which case then the next quarter firms work to reduce those inventories. So 1.4% of that GDP in the second quarter was from change in inventories, which got worked off to a great extent in the third quarter. So if we sort of average that out, GDP in the second and third quarters, we're in the 2.5 to 2.9% range, not that different from each other. In the United States, 70% of a dollar of GDP comes from the consumer, as the consumer is buying goods and services. And, somebody said in America, when the going gets tough, the tough go shopping, okay? It's kind of like therapy to help us through tough times. And it does help the economy. You can see the blue lines there, as the recent trends in consumer spending. And we've talked about, of course, the fact that consumers do have more dollars to spend. And so this is very bullish for the economy. When we look at the top 10 consumer spending categories, this is for the year 2014, percent of disposable income. We see that food and beverages rank number 4 on the list. We see that food services rank 6 on the list, and energy goods and services rank 7 on the list. So there's many things that you are selling in your stores that are very, very significant areas in consumer spending. And hopefully you're capturing and enjoying greater sales as a result of consumers having more money to spend in their pockets. Interesting trend since the turn of the millennium looks at the growth of U.S. spending on essential items versus non-essential items. And I'll be the first to admit that there's some arbitrariness in what's essential and what's non-essential. And I hope that the definition's been consistent over time. But the thing I would point out here is that from 2001 to 2007 and 2009 to the present, the growth of consumer spending on non-essential items has greatly outpaced the growth of spending on essential items. A couple of possible interpretations on that. One is that U.S. consumers in general are better off, and so they don't need to spend as much on essential items, so they're using this extra income to spend on non-essential items. Another interpretation is that the distribution of income and wealth has become much less equal in recent years, and so you've got a segment of the economy that's enjoying disproportionate gains in income, and they're the ones that are driving this bigger increase in spending on non-essential items. I'm inclined myself to believe that second interpretation, but we can say that the recovery, we can talk about it on average, but we have to recognize that different groups of people are impacted often very differently in an economy. I'd like to look at the vehicle area and the housing area in just a minute, because these are a couple of sectors in the economy that are enjoying a great run right now. This chart shows the trend of real per capita disposable income over time, and then real per capita spending on vehicles. And of course, when you go into a recession, you lose your job and stuff, you drive that older vehicle a few miles more. So we saw during the Great Recession, the fleet age went up for the average car in America. And now as those vehicles have gotten older and consumers have recovered, they're going out and they're replacing those vehicles, and they're buying newer vehicles. And so we're enjoying a real pickup in spending. Just as an example, at the depth of the recession, we were selling about 9 million vehicles a year in the United States. Last year we sold 16.4 million. This year we're on track to sell 17.3 million vehicles a year. And next year the forecast is even better at 18.1, as we make up for this deficit that we had for several years. If we look at new home sales trends and existing home trends, you can see that both of these are moving up in a positive direction. Housing is so important for the economy. 4 to 5% of our GDP is related to residential construction. These people that are working in construction are some of the best customers, in the convenience store industry. So when they're out working, they're stopping in your stores 2-3 times a day, and so forth. At the depth of the Great Recession, our housing starts in the United States had dropped to 500,000 a year. Last year, we were double that, at 1 million units started. This year, we expect to do about 1.1 million, and next year, even slightly better than that, approaching 1.3 million. So those sectors of the economy sort of counteract the weakness in the manufacturing sector, the weakness in sort of the oil-producing regions. We have to put this all together and say, well, what does that mean for economic growth? Last year, our economy grew at 2.4%. This year, it will really be about the same. We think it to come in about 2.5. We won't really know for sure until about May next year or June, when the final fourth quarter GDP statistics come out. Actually, I misspoke. It's more like March, April that we'll know the final. And then in 2016, which of course there's more uncertainty about how that will result, but the forecasts from a couple of major banks, are suggesting that will be slightly better than this year, which is really not going to be a bad year. So that brings us now to Janet Yellen, the Federal Open Market Committee, the Board of Governors, and their decision on when to begin raising interest rates. And those of you that have followed the Fed, they've announced that they're weighing inflation and what's going on the inflation front with what's going on the unemployment front. They helped bring us through the Great Recession and subsequent recovery with 3 massive waves of purchases of securities. You can see the line going up on the left there. Their portfolio went from less than $1 trillion to over $4 trillion, and they have to decide when do we start unwinding that and how to do that. So let's look first of all at inflation, and then we'll look at some employment metrics. First of all, measured inflation is at the lowest point since the recovery began. Consumer price index, almost zero. Social Security recipients will not be receiving any cost of living increase for this year. But we know that certain components of that inflation are transitory. We're not going to get a $100 barrel drop in oil prices in the next 12 months. We're not going to probably have the dollar strengthen dramatically from here, reducing the cost of imports. So as some of those things reverse, measured inflation will go up again. If we look at a measure of inflation that at least some members of the Fed like to look at, it's called the trim measured inflation put out by the Dallas Fed. It's running at 1.7%. So it's running a bit higher than this, but still below the target that the Fed has set. The Fed has set a 2% inflation target, and you can see that inflation in the last 4 years on a global basis, measured by the G7 countries, these would be our major developed countries in the world, has been below the 2% mark. If we look at forecasts for inflation, last year we averaged 1.6. This year we think we'll average 0.2%, so just call it 0 for the year. Next year, as some of those factors that I spoke about don't come into play and we get back to more normal, about 2%. One of the things that the Fed has to deal with is that the policies that they take today don't take effect tomorrow. There's a lag. So they not only have to look at what's currently going on, but what is the strength of the economy and what's likely to be going on. So the next thing the Fed looks at is the employment picture. One of the big stories of the Great Recession was this huge drop in the labor force and the labor force participation rate. Going into the Great Recession, which is in the shaded area on the chart there, over 63% of our population of working age was either working or looking for work. Well, if you look at the current number there, it's about 62.5%. And despite the fact that we've had 6 years of economic recovery, the fraction of the population of working age in the labor force has not come up. It's continued to decline. What has come up is the blue line, which shows what the employment population ratio is. But the dramatic decline we've seen in the unemployment rate has been partly driven by more people getting jobs and partly driven by people exiting the labor force. Part of this is demographics, because the baby boomers are now retiring and they're choosing not to work, but they're still considered to be part of the population of working age. When we look at what's going on in the employment picture, October actually was the biggest payroll increase of any month in 2015. Came in way above people's expectations with 271,000 new private sector jobs created. The blue line there shows you the 12-month moving average, which had been trending down a little bit, but now with the October numbers, there's been definitely some renewed optimism about how strong is the U.S. economy. We peaked out at 10.1% unemployment at the height of the Great Recession. We've been coming down about 1% a year. We're now down to 5%. When we look at some other measures like job openings, which is the middle bar there, it's accelerated dramatically, the percent of job openings. The percent of hires has gone up. And of course, as the labor market's gotten stronger, people go, I don't need to keep working for this jerk anymore, and the quit rate's gone up, okay? So it's gone up from 1.5% to 2%. Now, what we would expect to have happen, of course, is as the labor market tightens and the economy strengthens, wage increases go up. And it's been a long process. Wage increases have been very stagnant. But for the 12 months ending in October, the year-over-year increase was 2.5%, which is the best increase we've had in 6 year. If we look at some specific sectors of the economy, I circled here the retail trade sector. Their 12-month increases in wages are actually a little bit over 3%, so running at a higher rate than the nation as a whole. The solid blue line is looking at the year-over-year payroll change. So you can see what sectors are adding a lot to payrolls, what sectors are wages growing the fast. I might just point out on the bottom right, mining and logging, which would include all of the oil production, employment, and so forth. Huge year-over-year declines in employment there. Really the only sector that's doing that. So we expect wage pressures to go up. A number of companies have announced the minimum wage that they will pay any employee that works for them. Some of these are obviously in labor market pools that you compete with for workers. I know that the university I work for, the president, when he came on with his fall address, he announced that no one at the university now is paid less than $15 an hour. Okay, so these are some of the themes that we're beginning to see. And as we look at minimum wage and minimum wage legislation, there have been some dramatic increases in announced minimum wages. I'm from the state of Washington. The city of SeaTac, where the major airport's located, has a minimum wage now of $15 an hour. The city of Seattle is at 11. They're moving to 15 an hour. And so this is something that I think we're going to be faced with as we look ahead. If we look at monthly turnover for jobs in retail, this is not just convenience store, but this is retail generally. The monthly turnover has gone from 2 to 3% from 2009. And so this, in my mind, creates some major challenges for people that operate convenience stores, because we really do have a different labor market picture. The unemployment rate's getting lower, quit rates are increasing, and wage pressure's building, I think especially among lower hourly paid workers. The unemployment rate averaged 6.2% in 2014. This year it's at 5 now. We'll average about 5.3 for the year. Next year, probably continue to drop, maybe as low as 4.7. So this brings us back to the question about the Fed, okay, and what the Fed's going to do. Weighing against beginning tightening would be currently low inflation, a strong dollar, the weakness in exports that's created by a weak global economy and a strong dollar. But weighing for tightening would be low unemployment. By almost all measures, I think we're at full employment, a fundamentally solid economy, and the fact that interest rates are so abnormally low, when are we going to start to normalize them? And it takes time for adjustments. So you can look at people's opinion, which shifts rapidly. As recently as a month ago, only 37% of the people thought the Fed would raise rates in December. But with the new labor report out, with some of the recent pronouncements by different Fed officials and so forth, we now have 68% of people thinking that the Fed will raise their rates in December. I personally would give it higher odds than that. I mean, I just think it's going to happen, unless there was just some huge negative news that broke on the employment front in early December. So, plan for rate increases, if not in December, in the near future. But the other thing is, if you look at how rates are likely to go, the thing that Fed officials keep saying is, it's going to be a very measured approach. In other words, yes, we're going to start raising rates, but it doesn't mean that interest rates are going from 3% to 6% in the next 6 months. In fact, this trajectory here, the orange looks at what happened in the last Fed tightening cycle, where rates went from 1% to just a little over 5%, and the blue looks at kind of a more current outlook, which suggests rates may peak as low as just a little over 3% and take a long time to get there. This is Fed meetings, so it's about 6 weeks between Fed meetings that are marked on the axes. So Fed funds rate, which is the interest rate that banks charge each other on overnight loans, almost zero in 2014 at the end of the year. Assuming we get a Fed rate hike in December, they may finish the year at about 1/3%. They're not there right now. And 2016 may go up to about 1% by the end of the year. Long-term rates, which are probably more relevant to you and your capital spending decisions, averaged as of year-end 2014, 2.1%. 2015, 2.35 is what we think we'll be at, and maybe 0.5% higher at the end of 2016. Fiscal policy, even though we have some long-term fiscal policy issues for the U.S., I would say it's kind of a non-issue for the near term. The budget deficit at 2.25% of GDP is the lowest it's been since 2007, and Congress recently passed extensions to the budget and debt ceiling. It's going to carry us past the 2016 elections. So as we sum this up and talk about, what does all this mean to you, the lower national unemployment rate and the growth of employment definitely means more commuters driving by your stores looking for food and fuel. Very good thing. More labor turnover, less applicants per position open. So work a little bit harder on what you're doing to attract quality people. Upward pressure on wages, particularly at the lower tiers. The lower oil prices, a big factor in low inflation in 2015. Change in the mix of vehicles that are being demanded. Probably a slowdown in transition to alternative fuels, and definitely greater consumer purchasing power. How can you capture that? And economic growth is obviously variable depending on, are you mainly an oil producing region or an oil consuming area? The strong dollar also is low inflation as the price of imported goods fall, greater consumer purchasing power, but pressure on U.S. industry from foreign competition, and a reduction in the pace of economic growth, particularly from manufacturing. So overall, the U.S. economy should continue to grow, I think, with solid gains in real consumer spending, home price appreciation and home construction up, auto and light vehicle sales up. The inflation rate be close to zero this year, but I think we'll be gradually moving toward the Fed's target 2% range. And I think the Federal Reserve will begin to tighten in December, but if not December, in the next few months for sure, but take a very measured approach with gradual adjustments. And as a result of that, interest rates will probably rise by less than 1% between now and the end of next year. And I think they'll remain low relative to historical norms for the foreseeable future. That sort of finishes phase one on the economic outlook. We're going to move right in now to a look at the retail outlook.